So now I'm very pleased to introduce you to our two presenters for today, focused on accessing direct pay for nonprofits, churches, local governments. It's just an incredible opportunity through the Inflation Reduction Act that I'm excited to share with you all with the experts in the room. So I'll start out by I'll start out by saying that this presentation is a modified version of work completed by the Center for American Progress, the National League of Cities, the Blue-Green Alliance, and Lawyers for Good Government. So those three groups were involved in the creation of this presentation, and I want to make sure we give them credit for that. So we'll start with our presenter, Rachel Chang. Rachel is a policy analyst for domestic climate at the Center for American Progress. Her work is focused primarily on the power sector and clean energy development. She focuses on implementation of the Inflation Reduction Act. So she is absolutely the right person to have here. Jaron Goddard is an energy attorney for Wilson Sonsini, and she's a member of the firm's energy and climate solutions practice. Jaron's career experience includes former U.S. Senate staff counsel involved in negotiating and drafting the provisions of the Inflation Reduction Act, and has a strong industry background creating solutions for her clients in the clean energy transition. She also has experience navigating international, federal, state, and legal regulatory landscape. She is an active pro bono partner with Lawyers for Good Government. Another fun fact about Jaron that I want to share, just because I think it's great. Jaron led the development of the Clean School Bus Act on behalf of Senator Murray, which was successfully included in the IIJA. And that bill authorized a $5 billion program at EPA to spur the nationwide transition of 500,000 diesel school buses to EVs. And that's something that Montana has taken a part of. So it really comes full circle. Okay. Well, now that we have an introduction to our presenters, I'll kick it to you all. You have the floor.
You can go to the next slide. Thank you, McKenna, and thank you all for having me. I'm really excited to be speaking with you all about direct pay, which is also known as elective pay. Direct pay is a really huge opportunity to expand the reach of these clean energy tax credits. And I know that tax policy might not seem like the most exciting thing, but I promise this is a really transformative policy for public entities. So before the Inflation Reduction Act, only private industry has been able to take advantage of federal clean energy tax incentives. These are tax credits that have existed for more than 20 years that, for example, could provide a 30% tax credit off of the investment costs of a solar project for a private developer. But tax-exempt entities like state and local governments, public utilities, nonprofit organizations, and more were ineligible to claim these tax credits since they don't owe federal income taxes. But the Inflation Reduction Act includes direct pay, which is a brand new mechanism allowing tax-exempt entities to take advantage of these credits directly for the first time. So tax-exempt entities can file a tax form and receive a direct payment from the IRS as if you were a taxpayer. This essentially creates a new source of funding for clean energy generation and storage projects, electric vehicle fleets, EV charging infrastructure, and more for a whole new suite of stakeholders that can really accelerate the clean energy transition and advance economic and workforce development. Next slide, please. So again, this makes clean energy tax credits available to a range of different tax-exempt entities, including local governments, territories, public utilities, schools, tribal governments, and more. You can see the list on this slide. And if you're interested, I just want to flag to make sure you go through the guidance carefully. There are certain rules to be aware of. For example, partnerships are for the most part ineligible to claim direct pay. You must be the project owner of the asset in order to claim the credit. So yeah, just wanted to flag that to go through the draft regulations carefully. Treasury is going to be publishing final rules within the next few months. So just be aware that there are certain rules to be aware of. Next slide. So here are the 12 different tax credits that are eligible for direct pay. And it covers a wide range of different projects from clean energy generation, commercial EVs, manufacturing projects, carbon capture, and more. But I'll highlight some of the tax credits that are typically of most interest for state and local entities. Next slide, please. So these are 4 that are potentially the most relevant here for this group. So first, the 30C tax credit. This is a tax credit for electric vehicle infrastructure projects like EV charging stations. This credit is specifically available to non-urban or low-income areas. Treasury and IRS have a helpful mapping tool that can help you check your eligibility based on those two criteria. So we just urge you to go check out that mapping tool to see eligibility for this credit. Next, 45W. This is for commercial electric vehicle fleets, which can include things like government vehicles, school buses, and public transit. And flagging that these credits are all stackable with different federal funds. Last, the Section 45 and Section 48 tax credits. These are similar, both covering projects for clean energy generation and could provide credits for projects like microgrids, community solar, energy storage projects, rooftop solar or wind on government buildings, and more. But the important distinction between these two credits is that the Section 45 credit is a production tax credit, or a PTC. And you would receive that annually, meaning that you would have to file for that credit every year. On the other hand, the Section 48 tax credit is an investment credit, an ITC, which is a one-time lump sum payment. So many local governments might opt for filing for the ITC instead of the PTC, so you can receive a one-time payment upfront. So all in all, direct pay is really an enormous opportunity for public entities, gaining access to clean energy incentives for the first time and starting to level the playing field with the private sector. It'll allow local governments, churches, hospitals, schools, other nonprofits to really play an important role in deploying clean energy. Thank you so much, and I'll now pass it off to Jaron, who will walk through some more of the logistics of actually claiming direct pay. Thank you.
Thanks, Rachel. Great to be here with you all. I know I was introduced, but I'll just say my name is Jaron, like Sharon with a J. I've been to Montana several times. I do some wind work out in Montana, beautiful state. So lovely to be here with you all. McKenna, could we go to the next slide, please? Oh, right. So I'm an attorney. We have to have a legal disclaimer in here. Just obviously a quick note that nothing I say here is for, individualized legal advice and just for informational purposes only. So sorry, have to do the disclaimer part. So what I'm going to cover is sort of more of the nuts and bolts of how the direct pay will actually work, the mechanics of filing. The thing I want to say upfront, and maybe stepping back for a moment, there might be some folks on the call who remember now, gosh, almost 15 years ago, there was the ARA bill in 2009, the American Recovery Act, that authorized a program we used when we were drafting, as McKenna mentioned, I was on the Hill while we were drafting the IRA, that we used sort of as a baseline. So that was called the 1603 program. And that was the maybe more commonly known as the cash in lieu of grant program. So back in the 2008 financial crisis, when there was, again, a very sort of desperate need for infusion of government spending to help a struggling economy, there was we used the tax code essentially in a similar way to the way direct pay works now. So I always like to mention that because it is a new concept, but it's not without precedent. And so, if anyone here has prior experience with that program, there's lots written about that program as well. It is functionally quite similar. So just want to note that up front. The second thing that I'll say here is that, instead of the federal government using grants, we're using the tax code. And we're using the tax code for entities that don't have, by and large, any experience filing taxes. So, the first step here is really getting familiar with the process of, filing annualized taxes. That's not going to be an area of expertise that many nonprofits, municipalities, co-ops have necessarily in-house. So, a lot of these forms we list here and other steps are going to be very, very familiar to a CPA or an accountant or a tax attorney. So, we kind of mentioned this on number 2 here about building an internal team. I would not advise sort of if you're, and I'm a, energy project development and finance attorney, I would advise, finding the tax expertise within your organization, because they'll have a lot of familiarity with this and not sort of completely taking on all of these new concepts on your own without that type of expertise. So that's kind of really should actually be step number one on this slide. Okay, so the timeline for this, how does it work? I will say when we drafted this and what we were hoping would come out in the regulations is more of a regular pace cadence, perhaps even quarterly, of placing a project into service, getting a registration number, filing for direct pay, and then as a nonprofit or city receiving that direct pay in pretty short order, maybe within a couple of months. That was the vision. That's not what happened here in the ultimate regulations. And for many, many, many good reasons, that would have required Treasury to, hire likely, dozens to hundreds of personnel to manage those incoming requests. So basically what the avenue that has been chosen here is for Treasury to use their annual filing system as the main way in which they're processing all of the direct pay requests. So practically what that means is that for every project, so let's take a solar panel, rooftop solar panel project on top of a YMCA. What you're going to want to do is create a timeline for yourself. You first need to, and it requires sort of matching up the project development timeline. So, you're going to sign an installation agreement. You're going to sort of, you'll have to, look at your procurement and contracting timeline, because that project, that solar panel, needs to be what we call for federal tax purposes placed in service in the same tax year that you are filing for direct pay. What we outline here is that, that is to say that you can't, file for direct pay on a project that was placed in service 2 years ago. It has to be matched up to the same year. So the first practical step that you take is you have to obtain a pre-registration number for every single project as well. So, that is to say that, take the YMCA as an example. If they're going to do a couple of different things, if they're going to do, rooftop solar plus, buy a couple of, electrified vans to replace some of their retiring fleet in the same year, each one of those, the 2 vans and the rooftop solar, they all have their individual pre-registration number. I will say, especially because I know Montana is a big wind state, and I know PTC will be a little less likely, I think, overall, but to the extent wind is on the table here, one thing I want to note, because it's not always well known, is that each individual turbine has to have its own registration number. So on number 5 here, so these are just some of the kind of the listing of some of the applicable forms that you would go and find. A little bit of the sort of timeline implications here as well. This is a really great, essentially, overview slide for you to come back and refer to. Okay, McKenna, we can go to the next one. Oh, and there is, as you can see, a link on the pre-registration portal that you should use as a reference. Sorry, go ahead, yeah. There's also here, there's a great IRS video tutorial. It's pretty quick. I would definitely recommend watching it. It's an IRS tutorial video. It's pretty dry, but it's a really, really good resource. There's also sort of like questions and comments that can be received by Treasury, which is a really great tool as well. So this slide sort of documents kind of what you need to be collecting in terms of the information you'll need in order to submit to get a pre-registration number and for other compliance purposes. So definitely want to gather that information as you're kind of planning projects that you'll file direct pay on. And then 2 kind of important sort of notes here is that for right now, under the current regulations, tax returns can't be amended once filed for direct pay purposes. So we just really want to, we hope that changes as we note in the final regulations, but just a note to really try to get this right the first time. Again, we hope that changes in future regulations. Next slide, McKenna. Thanks. Okay, so this is my kind of practical project development and financing tips. As I mentioned, this is sort of a longer process. So I'd like to, give you an example timeline. You could, place a project into service, middle of the year, let's say in June. And you might not actually receive the direct pay given the annual tax filing sort of cycle for, 12 to maybe even up to 18 months. When you're signing, let's continue using the same example of a rooftop solar array, you're going to have to sign an installation agreement, your, payment schedule, which, can be negotiated with whomever you're using as an installer, for example, but, you're going to have to, essentially front that down payment. You're not going to get it. You're not going to have access to it for, potentially a year and upward, depending on the timing of your project. So one of the things I'll talk about it here, and John, it's actually number 2 here is the kind of project timelines and thinking about bridge financing. So, if you need to, think about getting a kind of short-term loan to front that down payment, if you want to, instead sort of take that as a negotiation point with an installer, sort of like breaking out some of those payments related to direct pay, those are the kind of discussions you'll need to have and things you'll need to consider in the overall project timeline. Actually, want to go down to number 5 here. I would kind of put it in red and bold. Is I think a really important overall piece about direct pay, especially for cities, is that, it's obviously a very powerful tool in the sense that you can get, using the ITC as an example, 30%, and even up to 70% in some cases, essentially direct discount on the cost of installing that system. And so that's a huge, huge benefit, especially at times when, city revenues, particularly in larger cities, have been, declining due to declining commercial real estate values. So I want to just say here too, I think being creative about ways in which projects can generate money, I should say, especially for cities, generate some revenue is a really good way to be thinking about, which projects should we prioritize. So I put a couple of examples in here about, public charging, bidirectional charging, these types of projects, I think in particular. On the ownership issue, so this is a really, I've sort of mentioned an installation agreement a couple of times. Let me explain why. So one of the biggest consequences of the regulations that came down from Treasury is that to elect direct pay, you must own the project. You have to be the owner for tax purposes in order to elect direct pay. That means that you can't, for example, work with a third-party, solar developer. We call it TPO model, third-party owned, where you're entering into a PPA or a lease, and you don't actually own that solar array. You are not the entity that qualifies for direct pay if that's the case. So that does, we'll say again, that was not what we were hoping for in the regulations, because I think it just sort of creates some additional hurdles. Having actual ownership has a lot of different legal, tax, and practical implications, but it is an absolute requirement in order to elect direct pay. So you have to own it. In the example of a solar or 45W for a vehicle, you can't lease, you can't have a PPA. Yeah. Oh, and then I'll get into, as I mentioned, the sort of using the ITC as an example, you can get 30%, all the way up to 70% of an ITC that's based on bonus credits. The, really big thing to note here is that I think for a lot of direct pay projects, and I would assume for many participants on the call, the bonus credit compliance obligations, there's a lot of relief for you if you're, in the ITC example, if your project is under a megawatt, which for solar is gonna, resi systems are significantly, even a lot of CNI systems are smaller than that. So what that means practically is that you don't have to comply with the prevailing wage and apprenticeship requirement, and equally the domestic content bonus, which is both a bonus credit and a penalty for direct pay. That does not apply if your project, the domestic content penalty essentially does not apply if your project is under a megawatt. And we can go to the next slide. Great. So this is just sort of a example I sort of put together about how you might think about what we call sort of the entire capital stack. So, using a direct pay credit. In this case, I use sort of a, fleet electrification, using 45W. In fleet electrification, you're obviously thinking not just about the vehicle, but the charger. There is a credit for charging. I should say a significantly expanded credit as well. That credit's been around for some time. It's now valued at up to $100,000. Essentially, the language has changed in the statute. It used to be 30,000 per charger. Now it's 100,000. We're waiting on guidance about everything that could be included in there, but it's very substantial. And then there's the tax credit piece, and then lots of other federal funds available for fleet electrification. There's, as McKenna mentioned, there's actually multiple EPA programs. I'm sure many are familiar with DERA. There's the new Clean School Bus program. There's other funds available for fleet electrification if you're at a port, et cetera. So you can. The one thing I want to mention, which has been a really, really common question I get from nonprofits and cities, munis, co-ops, is okay, I got a federal grant, I got the EPA school bus money. Does that impact how much I can claim of the credit? Generally, the answer is no. What the implication is that you can't, combine an EPA grant and the direct pay amount for more than what you actually paid for the bus. Pretty intuitive there. You can't get reimbursed more directly than the cost of the actual vehicle. And so what would happen, for example, because you're applying for, let's say, EPA federal funds, there's a lot of back and forth about how much per bus, let's say, for example, that you're going to get on a, let's say a $400,000 bus, maybe EPA gives you, $100,000 or $2,000. You cannot elect direct pay, for essentially more than that total amount. Or if the sort of the inverse, if let's say EPA gave you almost 100% of that cost, you'd have two options. You could either give some of the grant money back, or you'd have to reduce the amount of direct pay. One really important point here for any public entities considering using tax-exempt bonds. One of the big modifications in the IRA, it's still overall a sort of hit to using tax-exempt bond financing, but much better than what was the status quo before. There is essentially a 15% reduction in the value of direct pay. So to give an example, if you've got a solar system, 30% ITC, if you received, let's say you did 100% of the project with tax-exempt bond financing, you'd have to reduce your ITC by 15%, meaning that the ITC you would get would be like 25.5 or something like that. So it's essentially 15% or the lesser of the pro rata portion of the tax-exempt bond financing that you use. But just a note there, because I know that is a very likely combination for entities who are eligible for direct pay. So just a note on that. Okay, we can do next slide. Great. Right. So I mentioned some adders before. So this is like a very quick and dirty slide on what those adders are. I kind of mentioned both domestic content. There's both a bonus credit you can get on your ITC or PTC. I know I keep leaving PTC out, but there are equivalent increases to the PTC rate you would get for these as well. And a penalty only for direct pay applicants or entities. And so again, in the vast majority of cases for projects under a megawatt, this isn't going to apply. What you should know about the domestic content requirement overall is that, it's so exactly what it sounds like. There's sort of a certain threshold or percentage of your, total project that has to be, manufactured, assembled here in the United States to qualify, and you get 10%. I think sort of we have a lot of manufacturing clients, and what I would say is that I think in, you know, sort of the coming year or two, you're going to start seeing manufacturers who are more willing to give, you know, very you know, sort of robust representations, warranties about their domestic content amount. And I think there's going to be a lot more comfort in the next coming years, sort of as a couple of different cycles, tax years, people get under their belts and understand, you know, what does and doesn't count. So if it's something that you want to look at from a procurement standpoint, and I get that it can be very overwhelming now, I think we're going to see a lot of a good sort of improvement in that in the next coming years. Okay, next slide. Great. So these are the other applicable bonus credits. Energy communities. There is a lot of Montana that qualifies as an energy community, which is great. There's a really, really handy map. I don't believe it's linked here. We might be able to send it and follow up. Very, very helpful mapping tools that can qualify. And this is literally just geography based. And you get, you know, an automatic, you know, 10% increase to your ITC or equivalent to the PTC. With the low-income communities, so we call the LMI program, this one is the only bonus credit that is functionally very different than the other three we just mentioned. The other three, you know, there's requirements, you either meet them or you don't. You get in trouble upon audit if you said you met the requirements and you actually didn't. This one requires an application. So it's what we call an allocated credit. So there's a portal, as we mentioned here on the slides. It requires an application. This is one of the trickier aspects, unfortunately, combining the LMI adder and direct pay, because there's also a, you know, timeline related to direct pay when you file, when you get a pre-registration number. So this is, again, something where I recommend like literally creating a timeline for yourself, kind of with all the various deadlines, because you won't know whether you received the LMI bonus credit until it's actually the Department of Energy that's running it, sort of as a first pass until you're notified through the portal. So just a kind of another timeline note there. Next slide. Great. Okay, so these last couple slides are kind of obviously focused towards municipalities. So these are really just sort of internal questions. I think these were originally included in this presentation we gave about a week or so ago by the National League of Cities. And you know, these are just sort of some internal staffing questions to sort of ask yourself about, you know, your in-house, as I mentioned before, kind of tax expertise, legal expertise, you know, kind of who you actually need. So I think the most important is really tax expertise. I think, you know, if you're combining, as I mentioned, bond finance, tax-exempt bond finance, bond attorneys are very helpful. You know, for municipalities, co-ops, you've got internal general counsels, you know, it's a good time to loop them in as you're talking about building out portfolios that you can apply for direct pay. Let's see, next one. Okay. Yeah, and then this was a really helpful kind of project example with the roles, kind of like the roles that everyone would play. And so, yeah, it just sort of gives you like a helpful illustration of what everyone would do. Great, next slide. Risks. Okay, so this one I hesitate to end on a sort of like what are the risks of direct pay, because you know, I think it's a really powerful tool. It's been being mentioned, and I really don't want to discourage anyone from utilizing it and spending their time and resources to investigate how it can best fit your organization. But you should be aware what the risks are. So there's a couple of, and these apply to, you know, the for-profit sector as well. So it's not unique to direct pay in most cases, with the exception of the penalty for domestic content. But there's kind of a couple of different categories of them. So the first one is what we call recapture in the ITC context. So what recapture is it's and honestly, it's less of a risk here. Recapture has been a tax principle that applies to the ITC only, so not the PTC. As you mentioned, ITC is investment tax credit. You get sort of the full value up front. There's a 5-year period from the time you place a project into service for which recapture risk applies. And it principally means that there's been a impermissible change in ownership of the facility. The facility just, just a storm goes offline, is destroyed, is no longer operating, right? Because you've got this, sort of, it's, let's say 30% of the entire value of the solar installation, gets wiped out or stops, functioning 2 years later. The IRS cares about that. So there's a 5-year period for which sort of a pro rata share of that ITC amount can be recaptured by the IRS. So it decreases every single year as sort of linked to depreciating assets. So that is to say that it's not like in year 5 you are risking the entire value of your ITC getting clawed back essentially by Treasury. It's amortized essentially, so it's 20% of that over 5 years. But you just should be aware that there are certain things that can trigger recapture. Again, that's a really good thing to bring in a tax lawyer for. But frankly, it is not as the reason it is not a huge risk here is because, as I mentioned, for direct pay, your organization has to be the owner. And so it's, unlike in the private sector when we're doing tax equity deals and projects change hands, there's, companies get bought and sold. There's just really not that same level of risk here overall. Excessive payments. So these are, is kind of exactly as it sounds. You overvaluated. I just, lied to the IRS about it's also fraud, but about the value of your project. It also means sort of claiming bonus credits that you actually didn't qualify for in reality. So sort of on audit, those excess payments can be clawed back by the IRS. And then, as we mentioned before, there's penalties and reductions for direct pay, for tax-exempt bonds, and also for failure to comply with domestic content, but only for projects over a megawatt. So there's ways to mitigate some of that risk. A very common tool that we use is tax liability insurance. I think really most importantly is, when you're looking at if you're going to go for bonus credits in the ITC, building in the appropriate, warranties, reps and warranties, indemnities, documentation. All of this can get, if you're a municipality, can get built in, sort of hardwired now into your procurement forms, doing the right schedules that you'll need for disclosures for, domestic content purposes, what you'll need for energy communities and so forth. So you can build that into your kind of standard form of contracts up ahead. And I think that's really the best way to sort of head off some of that risk from the get-go. I believe that's the last slide, McKenna, unless there's one more. There is. Okay, resources slides. This is great. This is just like hyperlinks to a lot of resources. I am was mentioned, a participating pro bono attorney with L4GG. L4GG is really the clearinghouse for any legal questions that you have, because there are many, many participating firms. Their team receives intake. They farm it out to attorneys such as myself. If we're able to respond and help, we will. So they are a really, really good resource. I really encourage you to go directly to them. And then all of the other links here are very, very helpful for other questions and FAQs on all of this. And so with that, McKenna, I'll pass back over to you and happy to answer any questions.
Great. Thank you, Jaron. Really amazing content here. So since we're on the resource slide, we will get to questions in a second. One thing I will note is that the IRS is holding office hours for navigating the pre-filing registration portal, and their last office hours that I've seen published are coming up this Friday, February 9th. So I will be sure to get this slide deck out to you all so you have this abundance of links at your disposal. But just wanted to flag that if perhaps your nonprofit or organization is planning to file for the 2023 tax year, right, then that would be a really pertinent tutorial and office hours to attend this Friday. Cool. Great. So now I think we can move on to questions. We'll start with a few that came from the chat. Jaron, can you speak a little more to the tax-exempt bond financing that would reduce your elective pay eligibility by that 15%? There's just some curiosity here. I know there was a mention of CPACE or property assessed capital enhancements is what it's called here in Montana. However, that's only for commercial and multifamily properties. I suppose there could be a multifamily housing unit that's owned by a nonprofit. So maybe that could be the overlap point. Otherwise, it's all commercial. So those would be taxable entities who have access to PACE financing. But could you speak more to the maybe the examples of the type of bond financing that would make a elective pay reduction?
Yeah, so it really is the categorization that applies there is that like truly if the bond financing you're receiving is itself tax exempt. So that means the bond holder is not paying that is a tax-free bond, that if any part of that is part of the capital stack for your project, the amount of the direct pay is reduced. So the example I gave was 30% ITC. So like if you're using, let's say, you're not paying out like it's it's maybe only 20% of the total project cost you're using tax exempt bond financing. The calculation is it's a 15% reduction in the lesser of the amount of the tax exempt bond financing. So, or I should say, the better way to phrase that is it's up to a 15% reduction in your ITC basis. So, but it's based on the pro rata share. So like if you paid for 100% of your project with tax exempt bond financing, then you're going to hit the max. So you're going to have to reduce your ITC percentage by 15%. So 30% to 25.5%. It would be less, like you're not reducing it by, it's less than 15% if you're using less than 100% of your total project costs are coming from tax exempt bond financing.
Great. And Lori, if that got to the heart of your question, that was helpful for me. But if you had any other follow-ups, feel free to add them to the chat. Okay. In a similar vein, but not so much about bond financing, but just about the capital stack for a clean energy project. There's a question here about if you receive funding for, let's say, a solar system on a church using grant funding, whether that comes from the utility or a private foundation or whatever source it may come from, would the elective pay process, like that, the 30% that you could claim, would that be for the full sticker price of the project, or would, let's say you got $50,000 of a $100,000 project covered through grants, would you have to reduce the amount basically you're reporting to the IRS? Like, would you have to report that the system cost $50,000 because you had some grant stacking, or how might you approach that?
Right. Yeah. So I take the question to sort of mean like, how do we deal with sort of the various sources of funds we're getting to pay for our project, and does it impact how much we can actually claim? So, yeah, that's a great question. As a general matter, no, you don't have to reduce the amount of direct pay that you're claiming in that case. Again, this is where having a tax lawyer or an accountant involved is very, very important, because there are penalties related to excessive payments and so forth. But as a general matter, no, that will not reduce the amount of direct pay if you're getting like a state or federal grant.
Okay, great, good to know. And then for those out there who are looking for CPA guidance, or I know you mentioned the Lawyers for Good Government portal, which I think will be a great resource for many, but what might you recommend for groups to look for partners to work with? Like, what comes to mind for you, especially for those smaller nonprofits that might not have as big of projects? For example, we did prior to the start of this presentation and planning for this presentation, we talked to the Montana Society of CPAs. And then we also spoke with a few municipalities that are using a larger accounting firm. But again, that accounting firm specializes on larger institutions like schools, cities. But for the smaller scale organizations or institutions, what might you recommend?
Yeah, it's a great question. Well, I think that so there are green banks across the country who are really endeavoring to both give, practical guidance and tools, actually stand up, some bridge financing options for like smaller nonprofits. When it comes to professional services, this is, and it's tough, right? Because these are licensed professions, where giving, outside of organized pro bono efforts, the answer is you have to hire an accountant and you have to hire a tax attorney. That's why L4GG is really great, because there's pro bono legal assistance there, that can be that's accessible, and there's more and more participating firms. But like I can't give tax advice. I'm not an accountant. So I think that what I would really encourage is that, and I know I don't believe Montana is like particularly covered by a regional green bank, but this is an area that frankly needs to be developed. I think that some of the funds coming from the EPA to states to sort of help stand up some technical assistance and so forth can hopefully be helpful. I don't know what Montana's plans are in that respect, but on the sort of tax help request, I think I would still reach out to L4GG for now. I know that they are trying their best to sort of create those partnerships. There is also, I don't know if it was linked, but there is a state support center that's been stood up by a nonprofit with some foundation dollars. That's a really great resource for states. Again, though, these are more widely applicable tools and not individualized tax or legal advice. So short story is got to hire an accountant or find a pro bono one, and same with tax lawyers.
I see as I'm looking through the chat, and also if you do have questions as we're wrapping up this dialogue, feel free to put them in the chat. A couple of notes from Russ about their church commissioning a solar battery project. Let's see, Russ, if you're still on, I think you had a couple of questions about when you may be filing for direct payment, and then as well as a little more info about the project. If you are on, feel free to unmute and maybe give us more context on that.
Can you hear me?
Yes.
Yeah, we're just in the process of filing our final pre-application. We want to get some additional information to them, but we've got a problem with we didn't completely pay our main contractor until after he completed getting our system live. And that didn't happen until the very last second on the very last day that we could do that in 2003. So I don't know if we need to file two things or other. The other thing is that I put up on my Substack, Russ Doty, one word, .substack.com for free for small churches. A lot of what has gone on here is really great for some of your larger projects. And I'm no longer an attorney because I gave up my law practice. I'm 81 years old. But I thought I put in that Substack a lot of what you would need if you were a small church. And we're working with several other small churches here in Greeley and in Montana to get them up and running. There's one in Helena, for example. And also, there's some really, really good stuff on here, like the rural electric co-ops would be able to pay for up to 70% of their whole project, or 60 or 70% of their whole project, by using those bonuses. And I think that there's an awful lot of the rural electrics that don't understand that yet. And so if you're a solar person, that's where your sweet spot is. If you can go and convince them to put up a solar project, get 60% of it paid for by the feds, and you're off and running. So I hope that helps.
Great, first. I think, Russ, on your question, it looks like you had a question about the timing of the payment, so that the project was paid for partially in 2023 and the rest this year, but was commissioned last year. So can you file for the entire direct payment? So yeah, so the threshold for eligibility is when the project was placed in service. So not when the amounts were necessary. I mean, in this case, not when the amounts were paid. So the placed in service definition is a specific tax term, and I'm happy to follow up with some additional information on that. So it basically means when the project is electrified and working. So you've got your permission to operate from your utility, and the interconnection's all done, electrons start flowing. That's typically the what we call the placed in service date. It can get a little bit more complicated for utility scale projects, but basically the first day your array starts working. So as long as that was in 2024, you'd be filing for this upcoming tax year. So yeah, so I wouldn't in this particular case, the timing of the payments shouldn't pose an issue for when you actually file.
Thank you.
Yeah.
That covers the questions that I saw in the chat. Any other questions for Jaron while she's on the call with us? And you can use the chat or unmute yourself at this time if you'd like to pose your question.
This is Russ again. I have another question about, timing, basically. Actually, we paid for those solar collectors and the installation over 3 tax years. And so what I'm getting from you is that doesn't matter as long as we're up and running and getting solar electrons by the end of 2023.
Yeah, so is it like the project is functioning now?
Yes.
Yeah. So the threshold date is, yeah, exactly when it was placed in service.
The other thing that is on these tax forms, it kind of looks like that we've got battery and solar. So we got battery backup and solar. And I don't know if we need to put a special tax form in for the battery backup, or whether I can combine them with the solar and the other thing. It just doesn't seem very clear to me on the IRS tax forms.
Right. So I think the question is, do you basically need 2 pre-registration numbers? Are they treated as separate energy properties or facilities for ITC purposes? It's a good question. It used to be pre-IRA, the battery was, only allowed. I mean, there was no standalone ITC for the battery before the IRA. And so the, battery was sort of incorporated into the solar system, was part of the solar system. I think this is actually something I'd want to double check with some of my tax colleagues. I think you might have some optionality there, but let me double check, and I can follow up with McKenna on that. There's some sort of number one, it's new under the ITC that battery storage can be a completely standalone tax credit in and of itself. But 2, for specific direct pay purposes, I'm not completely certain whether you need 2 pre-registration numbers, so I can confirm and circle back with you.
Thank you.
Yeah.
Excellent. Well, seeing no other questions in the chat, we will wrap this up 5 minutes early. Thank you everyone for attending. I think if you take 2 things away from this presentation, it's the 12-minute video step-by-step guide for pre-filing, and the fact that the IRS is offering office hours this upcoming Friday at 11 o'clock Mountain Time. We will get these resources into your hands, especially the Lawyers for Good Government fact sheets and hands-on legal assistance. And we're so appreciative to Jaron for taking time out of your day to meet with us. So thank you all. I hope you have a great rest of your afternoon, and we'll catch you next time at the Exploring Energy series in March.